The billion-dollar scandal that almost collapsed Wall Street in the world of high finance. Trust is everything. Investors, banks, and governments rely on a delicate system built on confidence, regulation, and the belief that markets will behave rationally. But what happens when that trust is shattered? What happens when a single scandal threatens to bring down the entire system? This is the story of one of the most shocking financial scandals in history, a scandal so vast and devastating that it nearly collapsed Wall Street. At the center of this financial catastrophe was Long-Term Capital Management (LTCM), a hedge fund that was once hailed as an unstoppable force in the financial world. Founded in 1994 by John Meriwether, a former bond trader at Salomon Brothers, LTCM attracted some of the brightest minds in finance. Its team included Nobel Prize-winning economists Myron Scholes and Robert Merton, whose work on options pricing had revolutionized modern finance. With such intellectual firepower, the fund seemed invincible. LTCM's strategy was complex but, on the surface, appeared to be a guaranteed success. The firm specialized in arbitrage trading, betting on small inefficiencies in global markets. Using sophisticated mathematical models, LTCM identified discrepancies in bond prices and executed trades that would, in theory, deliver risk-free profits. The fund employed massive leverage, borrowing billions to amplify its returns. With Wall Street giants backing them and their models suggesting almost no risk, LTCM was seen as the future of investing. At first, LTCM's success was undeniable. The fund generated extraordinary returns, making billions for its investors and reinforcing the belief that its strategy was bulletproof. Banks and institutions lined up to invest, eager to be part of the revolutionary approach. The firm became a dominant player in global markets, executing high-stakes trades across the world. But beneath the surface, cracks were forming. LTCM's reliance on leverage was its greatest strength and its greatest weakness. By the late 1990s, the fund had borrowed over $125 billion against just $4.7 billion in assets, creating an astonishing leverage ratio of more than 25 to 1. This meant that even a small shift in the market could wipe out its capital. But LTCM remained confident, believing its models accounted for every possible risk. The problem? Markets are not always rational. In 1998, an unexpected event sent shockwaves through the financial world. Russia, facing economic turmoil, defaulted on its sovereign debt. The global markets panicked. Investors fled to safe assets, disrupting the carefully calculated trades that LTCM had placed. The fund's positions, which were supposed to be unshakable, suddenly turned into catastrophic losses. Within weeks, LTCM lost billions. The market instability triggered by the collapse of its trades created a chain reaction, threatening major financial institutions worldwide. The crisis escalated quickly. LTCM's losses mounted at an alarming rate, and its vast network of trades entangled nearly every major bank on Wall Street. The Federal Reserve realized that if LTCM were to collapse entirely, the resulting market chaos could bring down the entire financial system. The stakes were higher than anyone had anticipated. In a desperate bid to prevent a total meltdown, the Federal Reserve stepped in, orchestrating a historic bailout. 14 of the largest financial institutions, including Goldman Sachs, Merrill Lynch, and JP Morgan, agreed to inject $3.6 billion into LTCM to prevent its complete collapse. The bailout was not about saving LTCM itself, it was about saving Wall Street. If the hedge fund had gone under, the ripple effects would have devastated the global financial system. The LTCM scandal exposed a terrifying reality. Even the most sophisticated financial models could not predict the full complexity of real-world markets. The idea that markets always behave in predictable, rational ways was shattered. The crisis forced regulators and financial institutions to rethink risk management and leverage, but the lessons were not fully learned. A decade later, the 2008 financial crisis would prove that Wall Street had not abandoned reckless risk-taking. In the end, LTCM was dismantled. Investors lost billions, reputations were ruined, and Wall Street narrowly avoided a disaster that could have rivaled the Great Depression. The scandal was a stark reminder that unchecked greed, overconfidence in financial models, and excessive leverage can bring even the most powerful institutions to the brink of collapse. So, what can we learn from the LTCM disaster? First, no financial model is perfect. Markets are influenced by human behavior, fear, and unforeseen events that no algorithm can fully predict. Second, leverage is a double-edged sword. It can amplify gains, but it can also magnify losses to catastrophic levels. And finally, trust in the financial system is fragile. When it is abused or misplaced, the consequences can be devastating. The LTCM scandal remains one of the most shocking financial disasters in history. It was a near collapse that exposed the vulnerabilities of Wall Street and forced the world to reconsider the risks lurking beneath the surface of high finance. It serves as a cautionary tale, reminding us that in the world of money and power, even the most brilliant minds can be blindsided by their own arrogance. While LTCM is gone, the lessons it left behind still echo through Wall Street today. The question remains, have we truly learned from the past? Or are we doomed to repeat the same mistakes? Only time will tell.